Hey everybody, Steven Sidkowski here. I am the Chief Investment Officer and co-founder for Market Mastery Group. We are a team of people dedicated to teaching folks just like you how to be able to successfully trade the financial markets. And so I've got a great lesson for you today with a strategy that has broad appeal to it. It is known as a straddle. So basically with a straddle, here's what we do. We're going to be buying simultaneously a call option and a put option. So for those of you who are not familiar with options, a call option is what we use if we think the price of a stock is going to go up. A put option is the proper option if in fact you anticipate the price of a stock going down. Now, hopefully you're thinking, wait a second. Why would you expect the stock to go both up and down? Why would you do both a call or a put? When we do straddles, we're really acknowledging that we have no idea what direction the stock is going to move. We just believe that it is going to move. So why would we think that it is going to move? Because we know that there's some event that is on the horizon, and normally that event is a quarterly earnings announcement. So all publicly traded companies on a quarterly basis announce their earnings date. And on that earnings date, they tell the investing public how the company is doing, how much money they made, what the revenues look like. And they also put in guidance for the following quarter. And they have to be as honest as possible about all of this. So once these announcements are made, if in fact the company beats the analyst expectation, normally the stock jumps up. If they disappoint, the stock goes down. Problem is nobody knows if they're going to beat or disappoint until it happens. So we're going to cover both sides of this trade. Pretty tricky, right? So let me give you the rules. First of all, we're going to go out 2 to 4 weeks before earnings. So let me explain why we do that. Why wouldn't you just put this trade on the day before the earnings announcement? And the answer is this. One of the elements that goes into the price of an option is something known as implied volatility. The higher the implied volatility, the more expensive the option. Implied volatility generally goes up the closer we get to earnings. So the bottom line is if you buy right before the announcement, you are overpaying for the options. You're not just buying one of them, you're overpaying for 2 of them. Makes it very difficult to make money. We're only going to do this on stocks that trade for more than $20 a share. And generally speaking, if a stock's less than $20 a share and I want to control it, I'll just own it. So we save options for securities that are trading above 20. We always want to make sure and check the implied volatility, and I'm going to show you how to do that. Don't assume that because earnings aren't coming up for another 2 or 3 weeks, that implied volatility is low. There could be other things that are affecting implied volatility. So we always want to double check that. Pick stocks that move. Okay, so again, we don't care if it's up or down, but we want a stock that generally has a big move. And let me show you how I find those. I actually cheat. I have a piece of software. You will have access to this if you would like. And the software does, all the heavy lifting for us. And so let's do this. I am going to utilize a nice little feature here. I'm going to go to Find and Scans. And over here, we're going to go down, and I'm going to tell you how you can get a free trial of the software. I'm going to go down to where it says upcoming earnings with move potential. So as of right now, we have FedEx and Nike and Darden Restaurants. So we have 3 of them to pick from, and it tells me how much they move after an announcement. FedEx, almost 8%, Nike, 5%, and Darden, about 5%. By the way, if we wanted to look at the options and find out about implied volatility, this is how we would do it. So the implied volatility, when you're looking at the options chain, that's where you go to actually take a trade. The implied volatility will be down here. So I look at the average. So in this case, the average was 39. The implied volatility is 47. Wow. So the implied volatility is higher. So what does that mean? Options right now on this security are fairly expensive. And this is exactly why I tell you, you want to check them. But in any event, let us continue. All right. We're going to buy options that expire at least 60 days into the future. Okay. So let me show you what that looks like. I always like being able to be as realistic with everything as possible. And when I teach, this is the way that I teach, right? Plain English. So let's say that I wanted to do a straddle on FedEx since it came up on the list. So let's see, July options expire in 32 days. So I'm going to have to go out to October. And right now FedEx is at about 149 and change. So I'm going to buy both a call. So I put in one there and a put. Calls are on the left-hand side, puts are on the right-hand side. I do have a lesson on how you actually take a trade. I'm not going to spend a lot of time here. Click on the trade button and it loads the trade up for me. It gives me the bid and the ask, and I'm going to be able to go somewhere in between those two. So I can probably buy these two options for $27.65 per share and click review. And I'll just go ahead and take that trade. I'm doing it inside of a virtual trading account. Okay. So that's what that looks like. Notice it says live because the market right now happens to be closed. All right. So let's go back, see what the rest of our rules look like. Everything that we do, we are following very specific rules and guidelines. Okay. So we went out 60 days. Now it says exit early if possible. Almost everybody who does straddles, they buy a call and a put. By the way, there is a cousin to the straddle known as the strangle, where you're buying out of the money calls and puts. Those of you that attend one of my webinars or one of my classes will teach how to do that. But in any event, generally speaking, as we approach the earnings announcement, implied volatility goes up, sometimes to the point where you can literally sell these options before the earnings announcement and be able to capture profit. And here's what I tell folks. If you can make 10% or more, take it. Don't hold it through the earnings announcement because there's no guarantee as to how much this stock price will move. If you do hold it through the announcement, you're going to want to sell the winning side of the trade. In other words, let's say the stock jumps up. You're going to want to sell the call option. Just hang on to the put. Why? Because there's almost no value in it. And there'll be times when after this thing jumps way up, it's going to start coming back down and you're going to be able to double dip. Be able to get the big money off of the winning trade, the call in this case, and be able to get some more money off of the put option. So this is how we do straddles, and we follow the same rules when we do strangles. You want to learn how to make money regardless of whether the market goes up, down, or sideways. I'm going to suggest that you join me for one of my free 1-hour webinars. Get a little taste of what we're about, the way that we teach, and then you decide if trading is something that is really going to be important to you. And if so, we have a class that we offer folks, but I would just go ahead and click on the link and register. Coming to the webinar, no cost, no obligation. Nobody's going to bug you. I just want to share the message with those of you who have an interest in that. Okay? Awesome. Hope you enjoyed the lesson. And I really hope that I will be seeing you soon at one of our upcoming webinars. All right. Till next time, God bless everybody. Stay safe. And I hope we'll be chatting in the very near future. Bye for now.